Hi, how you doing? Poor here. Glad to see you. And well, it was an interesting week. Palantir shot up at the end, and it was fun time to see the portfolio grow and all sorts of that crap. But also, we are post another rate hike, and so a couple interesting things has happened with that as far as Robinhood raising rates. I can kind of talk about that. We did a short about it, so we'll go over that real quick. We'll talk about Palantir discussing their earnings soon enough. And the main topic today is going to be options and what they are and how to use them. So, with that, let's do it. So, as you can see, we're currently at $304.20 on the $5 portfolio, and we've only invested 200. And a lot of this is due to Palantir shooting up at the end of the week. I mean, it's up 13.99% in a day. That's crazy. 1841, I think our average price, I can tell you what our average price is. Yeah, right there, 17. So we're up over a buck 30 per share on almost three shares. So yeah, that's gonna get you close to $4. So it was a pretty good day for the $5 challenge on Friday. That was cool. Cool to see. And yeah, also one of the other things that I wanted to discuss was the fact that we have a earnings, or you can earn a 4.9% APY, which is annual interest, uh, in your uninvested cash on Robinhood. Now, I did a very short video on this over the week just to discuss it because at 4.9%, really what you have to do in order to break even. So the math on that real quick is if you take so in order to get that you have to have Robinhood Gold. Now, Robinhood Gold is $5 a month. So, in order to break even on your $5 a month, you have to do a $5 divided by 0.049, which is 4.9%, and that gets you $102. And that's just for the 1 month. So, like, that would be all year long. So, you need to multiply this by 12 months in order to get $5 a month, which means you have to have just under $1,225 of free cash to break even on your Robinhood Gold, which gives you basically a net return of 0% APY. So we did this a couple different ways, which is kind of fun. Obviously, the more money you have in your account that is not being used, the better off it is because that $5 becomes less and less and less of a percentage of it. So let's just run through another quick calculation. So if you take, let's say, if you want $5,000, if you have $5,000 and you multiply that by 0.049, that'll get you $245. And that's all year long. And so $5 times 12 is 60 bucks. So if you subtract 60 from that 245, that means you would get a net return over the course of the year of $185 on your $5,000. So if you take 185 and you divide it by 5,000, that'll get you your actual percentage, which is 3.7%. Now, what if we double that 5,000 to 10,000? You go 10,000 times 0.49, and your annual is 490. You subtract 60 bucks again, and then you multiply that, or you divide that 430, excuse me, by, you guessed it, you divide that by the 10,000, which, if you can do math quickly, 4.3%. So now you're closely approaching that 4.9% because $5 a month, that $60 is much less percentage of that 430 than it was previously. And again, if you multiply that again by two, so $20,000, because we're having fun with numbers, times 0.49, get you 980, subtract 60. There you go. Divide that by 20K, 4.6. And it just keeps going like that. So eventually you get to that limit where you're not quite at 4.9, but you're close. So with that, obviously, if you have, 10 or 20K to just leave sitting on the sidelines, an almost 5% investment is not, what was it, 3.7 to 4.6% return with no risk. That's pretty good. But if you only have 1,200 bucks ish, it's not worth the $5 Robinhood Gold to do so. So that's just something to keep in mind. But yeah, it's an interesting concept that you can get almost 5% return on just leaving your money in an account. And there's a bunch of accounts like this that'll do that for you. It really kind of makes it an interesting market out there because there's a lot of stocks that aren't going to give you a 5% return. There's a lot of stocks that aren't going to give you a 5% yield dividends. There's a lot of stocks that aren't going to give you, there's a lot of things that aren't going to give you, like collectibles now are an entirely different ballgame because the whole idea behind collectibles is that they grow at roughly 5% every year because they're rare and hard to get. And as the years progress, there's fewer and fewer of them. But there's not a lot of money pouring into collectibles because they're a risky asset because they could go up or down. Whereas if you just stick your money in an account, if you were to buy $1,000 worth of magic cards, let's say, brand new stuff, maybe it goes up or down. Maybe it's something like that. But if you just stick your thousand or your $1,000 above the 1,200 in this account, you're going to make 4%, 4.9% on that $1,000 essentially. So, 2.3%, but still that's better than it going down. But yeah, it's pretty wild. It really changes the dynamic of investing because with such high interest rates, there's a lot of almost risk-free places you can just stick money to get interest. And why wouldn't you? Because I mean, yes, inflation was up, and real fuel inflation is still higher than the 5%, but it's better than it was, and you're getting a lot more than if you just stick your money in a savings account at 0.02 at a bank like Bank of America, who's been apparently opening accounts on their customers and just charging them late fees to make their bankrolls look better, and people are oblivious to this because they don't watch their personal finances. Get out of Bank of America; it's a terrible bank. But yeah, so that's basically all I have to say about that 4.9% APY. It's a little misleading, but it's really not a bad gig if you have enough money to make it work for you and not against you. So if you got, anywhere between 10,000 and up, I'd say it's not bad. You are also insured because of Robinhood up to, I think, $250,000. So if you have $250,000, you're getting real close to that 4.9%. You're like at 4.89999. So, yeah, um, that's free money for people who have enough to do it that way. But anyway, let's get into options. What do you say? We're gonna do SPY because a lot of people know the S&P 500. A lot of people know SPY, and I feel like it's one of the easiest things to kind of talk about. Now, to get into it, what is an option? At its basic level, an option is a contract. And we did this all throughout our podcast when we were doing it on podcasts and not on YouTube. So feel free if you need further advice to look back to the podcast. You can find that anywhere you find a podcast, still PLTR. But the thing that you're going to want to know is essentially an option is a contract to either buy or sell 100 shares of the underlying stock that the option is on. Let's say that's slower. If I wanted to buy, call, or a put, that is a contract worth 100 shares. So let's just work that out. Do an example. I want to buy a 460 call on the S&P 500, and whatever date is fine, doesn't matter. That we'll get into. That would cost me 18 cents a share if you look here. So 18 cents times 100 shares, that's an $18 contract. It would cost me $18 to buy this call at 460. Now what happens is you're going to have different parts of this that you need to be aware of. There's the expiration date because these are limited time things. These aren't like holding a stock. These are something that'll expire. So the expiration date is the day that contract will either execute or be worthless. So right now we have a July 31st, which is a 1 day contract. So it would expire tomorrow during business hour, right as the end of market close. So at 4 o'clock tomorrow, this thing's either worthless or it's not. And so you have to be aware of what day you're getting your contract for. With that in mind, so if I were to continue with this, I'm buying a 460 call at 18 cents per share or $18. So I need the stock to be above $460.18 just to break even on this because I'm going to give someone $460.18 per share, but I'm giving them the 18 cents per share in advance for the opportunity to be able to buy these shares at 460. Making sense? I hope it makes sense. If not, leave a comment. I'll be happy to answer any questions. So, what happens? There's a couple things that can happen here. Either I buy this call and the price of SPY goes shooting up tomorrow. Let's say it goes to 470. So, this contract's going to be worth roughly $10 at the end of business. I have to sell it before the end of the day in order to collect that premium. Otherwise, I have to pay someone $460 times 100 or four, what was that, 46,000? Yeah. So I'd have to pay $46,000 to someone to collect my 100 shares. So if you're on a margin account or something, that's probably not going to, do you any favors. Granted, hopefully it will be worth that you can sell those shares the next day at 470 and collect that basically $1,000 premium difference between 460 and 470 and sell those. Or you can sell this contract before expiration back to someone. So let's just keep it simple. Say there's two people. They sell it to you for 18 cents. Price goes shooting up from 457 all the way up to 470. So now at expiration, that contract's going to be worth $10 per share because the difference between 460 and 470 is $10. Makes sense? So you can sell it back to them and they will pay you $10 a share to sell it back to them. So you've just collected 10 times 100, $1,000. Pretty sweet. All for 18 bucks. That's a hell of a day. The odds of that happening? Eh. So that's basically a call. And a put side is essentially the same thing as a call if you're buying it, but you're betting that the stock would go down. Make sense? So instead of the price going up, you're hoping that the price goes down. So, like if you were to buy a put, let's get out of that. Go over to the put. Always watch what you're doing buying, selling, call, put. Put is just a call in reverse. So you're hoping that the price goes down. So, same thing. You'd buy this one and you would buy it for 23 cents per share. So you need it to go below 453.80. Yeah, it tells you your break even point actually. 453.77. Break even right there. Pretty great. So if it goes down, you need it to go down lower than 453 essentially in order to even make a profit. People don't like betting against the market. It's kind of like, betting on the don't come on craps, but let's not get into that. Things go both ways. So, you can make money going up or money going down, so long as you have a risk tolerance that allows for that. But essentially, the really tricky parts are when you start adding in calls or you sell a call, put or whatever. Those are the things that make options start to get tricky. But at the end of the day, no matter what you're doing, just remember that you can buy that the basic idea behind calls and puts are they are contracts for 100 shares of whatever underlying asset. That's the easiest thing to remember. Calls are for options that you want to bet the stock's going to go up, and puts are betting that the stock is going to go down. It's that simple. That's the basics of it. Everything else, that's where it starts to get complicated. Always remember those two rules. Calls go up, puts are betting down. And you just see, and you have your break even points and everything all laid out for you right on Robinhood if you're a new trader. I mean, that's as easy as that. So Just remember that, and we'll keep these things coming in. And if you have any questions, feel free to leave a comment or go check out the podcast because we still have that up wherever you're going to find your podcasts. And we've got all of the options outlaid right there. So, with that, let's get back to Palantir. So, their earnings call is coming up on the 7th of August, Friday. Let's double check it. No, that's next Monday. So, not tomorrow, but a week from tomorrow, what as of the recording of this, because today is July 30th. So just something to keep your mind on. Remember that the stock could go up or down. Earnings calls are always crazy. This is why people like to play them. But if you're not a very big risk tolerance kind of person, steer clear. So, well, I hope that was sort of educational, sort of interesting. And if you have any questions, always like, subscribe, leave a comment. Love to hear from people. All right. Thanks for stopping in.